Hello, welcome, and thank you for joining us from wherever you are in the world. So by way of introductions, I'm Paul Mills. I'm CEO and founder of VCMO. If you're not familiar with VCMO, I launched earlier this year in July. We're a marketing advisory firm that helps businesses build a competitive advantage through marketing transformation. And we do this by outsourcing fractional chief marketing officers to businesses that operate either with or without a CMO. We also work closely with investors, supporting their marketing due diligence on investee businesses and to help increase the value of portfolio companies through marketing optimization. So why are we running this webinar? Well, one of the fastest ways to achieve growth is through external investment. And there's two ways this can happen. The first route is planned financing, where you approach lenders or investors directly as a business, or perhaps indirectly through brokers and corporate finance advisors. The other route is probably a little bit more unplanned, and that's when investors approach you. And this might happen if you've been regularly appearing in the trade press, winning awards, offering a breakthrough solution, or simply by word of mouth. And when investors approach you, it will be when you least expect it and when your business is least prepared to go through their level of scrutiny. So today really is all about helping you prepare for investor scrutiny if serendipity comes knocking at your door. And in this webinar, we'll be covering four broad topics. We'll be looking at the power of external investment and how that can accelerate growth. We'll look at the marketing you need in place to attract investors. We'll look at how to effectively engage with investors. And we'll also talk about what you can expect during the pre-investment journey. So now's probably a great time to introduce you to the panelists who will be sharing their investor secrets. I'm absolutely delighted to introduce Ben and Rob. Guys, can you do a couple of moments just to introduce you and your businesses to our guests? Ben, do you want to go first?
Yeah, sure. Thanks, Paul. And welcome, everyone. For those who don't know me, my name is Ben Cooper. I'm an angel investor and supporter of the tech ecosystem in the southwest of England. Spent 25 years in financial services, everything from starting my own unit trust company to working for AXA Wealth. My final gig was at a discretionary fund management company in Bristol, which we sold to a FTSE 100 wealth company in 2016. Did a couple of years of earn-out from there, and since 2018, I've been working with startup and scale-up businesses in Bristol and the Southwest, but also become an active angel investor, supporting startup companies to raise investment.
Thanks, Ben. Rob?
Hi, good morning. My name is Rob Nichols. I'm a Chief Financial Officer for a number of businesses in the south of the UK, board advisor and non-executive director of a number of businesses. I'm also an advisor and mentor to Innovate UK, which is the primary arm of the UK venture funding from government sources. I also run a small private venture builder here in the UK with about 3 current angel investments in it. I've been back in the UK about 4 years. Before that, I worked and lived in the US since about 1997, so about 23 years in the US, living and working as an investor, CFO and an advisor in the US. So I know the US markets as well as I do the UK markets.
Thanks, guys. What I'm going to do, just before we go into the first topic, I'm going to set up a poll. I'm going to click that on your screen now. So for the guests, please do feel free to let us know whereabouts you are at the moment in terms of your investment journey. I'll just leave it open for you to vote. But let's now start the discussion. The first topic focuses on unlocking growth and the power of external investment. So Ben and Rob, can you share your thoughts on how venture capital, private equity and financing in general can fuel business expansion and innovation? Do you want to go first, Ben?
Yeah, sure. So, absolutely, investment is cornerstone for supporting innovation in the UK. Most early stage businesses require some kind of investment. It's often very difficult to get debt funding, etc., from banks and other lenders when you don't have revenue and you're very early stage, you're potentially in research and development stage. So often the case is that you turn to equity investors, certainly in a sort of pre-seed stage, angel investors and pre-seed investment funds. So that's kind of an essential aspect of getting your company on the board, off the ground, and moving forward and investment into your product to MVP or even to launch. The thing about equity investment as well is that it unlocks so many other different forms of funding. As Rob mentioned, Innovate is the principal funder of R&D grant funding in the UK. But one of the key things about that type of grant funding, and most of that grant funding that's issued, is it comes and requires match funding. And that match funding is often angel investment or early stage VC funds. And so even if you're a really early stage company and you require a grant for helping you develop your piece of tech or your innovation, you need to then go and find perhaps between 30 and 50% of that project cost from angel investors. And so it's an essential source of equity, not only for funding your business on its journey, but also for unlocking significant other channels of investment as well and funding. It also unlocks other types of funding from the government through the Irish Business Bank. So things like the Angel Co-Fund, the Regional Angel Programme, these are all co-investment pots of money which are available to funds, or certainly available to companies. They co-invest alongside angels, which again provides further avenues for the government to invest in innovative companies. So equity investment is, certainly early stage equity investment is a cornerstone to getting early stage and startup businesses off the ground.
Thank you, Ben. Rob, what are your thoughts?
So having worked in the US for a long time, I constantly find myself comparing the UK and the European markets to where the US is. And it's easy to get a little bit downhearted, if you will, particularly currently. The last 18 months has been difficult for raising funding as a founder unless you've already raised funds in the UK. So it has been a difficult market in the last 18 to 24 months. And at the same time, the US has been a difficult market. It has been more difficult to raise funds than it was in 2019 through 2022, which were kind of the heyday, and the valuations were significantly boosted, if you will. And of course, when valuations of businesses, both listed and private, are higher, it becomes easier to fund new startup opportunities or new and startups and founders, if you will. So what we found, particularly in the UK in the last 18 months or so, it has been particularly difficult to raise funding. And so, as Ben says, the importance of angels and non-dilutive funding, such as grants from Innovate UK, amongst others, has been of heightened importance, because there just has been a dearth of capital. And you have to understand, I think, as founders, that the bigger picture here, because, the reason the market has got tight is because the Bank of England and the Federal Reserve in the US raised rates quickly and significantly, sort of 500 basis points. And so what that does is it basically sucks away all the liquidity in the market that was available in 2020 through 2022. And so it has been difficult for a reason. It's a deliberate policy to dampen the market. And so liquidity has dried up to a large extent. And so, bootstrapping is very operative right now, but equally angel investment is of a heightened importance, because other funders of startups and even some scale-ups, venture capital has been taken off the market. Private equity, a lot of it, and family firms has just dried up. A lot of the funding that has happened from those sources has gone to existing portfolio companies. So if you're a startup founder with a great idea or a great service and you haven't had funding before, it has been very difficult, and probably will be for another, I would say, 60 to 90 days, particularly in the UK. But I do see expectations that in the second half of next year, things will be looking better from a funding perspective. And so this is quite apropos right now, because if you're starting to look to necessitate funding next year, starting now with this webinar or the playbook, talking with people, it's probably a good timing. It's probably good timing, because you'll need 90 to 180 days at least to get your act together, to get all your ducks in line before you start really properly engaging in the market. And hopefully by then, the market will be more acceptable, if you will.
I think anything else to add there, Rob? That's okay.
Yeah, so I was just going to agree with Rob. I mean, absolutely, the market since Q4 of 22 has been extremely difficult for raising private equity. So in that, what that means is, if you are raising money, you need to ask for money that gives you a longer runway. So if you're looking, whereas previously you might have asked for enough money to get to last you, say, 12 months, and then you'd raise again, because the process is so difficult now, and that and elongated because of the conditions in the market at the moment. You tend to be looking for sort of 18 months plus now of funding, and that means probably giving away more of your company at a lower valuation because you need to secure that funding, because you need to have that security, and that's one of the impacts of the sort of current market situation.
Great stuff. I'm just going to publish the result of the poll, and 6 of you have voted. Not all of you may be looking to speak to investors at the moment, but it looks like half of those who have voted are already speaking to investors. So just like Rob mentioned earlier, now is really an opportune time to really start those discussions and start the journey so you can make some good headwind in 2024. It's probably a good time now to turn our attention to the role of strategic marketing and how that can be used to attract investor interest. Ben and Rob, what marketing approaches can businesses take to become irresistible to potential investors? Who wants to go first?
I don't mind. I can go. Yeah, it's as we're talking about, it's a really difficult period at the moment, and so you need to make yourself your real proposition to stand out from others. And so there's a few things that you can do. And as you mentioned at the start, actually, Paul, is shining the spotlight on what you're doing. So the use of social channels, awards, working the tech ecosystem, I suppose, and working the investment ecosystem. And that can be angel groups. That's using your LinkedIn connections, etc., just to highlight what you're doing. So when people see you, they start to see you, and when you're going to be looking for money, they know who you are. There's an aspect of almost socializing what you're doing, what your proposition is, what it does, what problem it solves, all those sort of messages, those elevator pitches, those short conversations and network and events, etc. You can get yourself around to just talking about what you do. So you become known in the ecosystem. That makes things a lot easier when it comes to the point of actually wanting to raise money. You're not going from a cold start. It could well be oh yeah, I've heard about you, or I spoke to you at an event months ago. I remember what you're doing. Just, update me on where you are, and let's have a deeper conversation about what you're doing. So it's about just socializing where you are, raising your profile, I suppose, of what you're trying to achieve. The other thing is, and it's a difficult one, because particularly in the innovation sector, is you have to be commercially minded. So we speak to, as an angel group, and I recently formed with a couple of colleagues, Angel Investors Bristol, and so we see a lot of decks, and we see a lot of companies come to us hoping to get in front of our 80 plus members to raise investment. We see a lot of highly technical businesses, there's a lot of deep tech businesses, but with founders that are into the tech, but not necessarily into the commercialization side of it. My experience is a high tech business, you might have the best tech, but you don't necessarily win the game, or you don't, because we've all had the VHS versus Betamax analogy. I think thinking back into those days, but I think Betamax was better quality, but VHS had a better marketing, and so they won the race. Betamax disappeared, and it's the same in the investment game. If you've got second best tech, but you've got the best commercialization, you've got the best plan, you've got the best people to bring it to market, that's going to win over a company with the best tech, but without that plan, without that commercially minded. So it's really important that you have a clear understanding of your business model. How are you going to make money? How are you going to get to market? And you have the right people who are going to give confidence to the investors that they're going to deliver on the opportunity which you're presenting them with. You may be solving a significant problem, but you've got to have confidence in that team that are going to deliver. So it's about socializing what you're doing, raising your profile, but ensuring you've also got the right team and the right people in place. And it's difficult for founders. I work with a lot of different founders, and there's often some tough conversations around what their roles are in that company going forward. Usually as a founder or a couple of founders, someone takes on the role of CEO, someone takes on the role of chief technical officer or whatever it is. But often, we'll have conversations around, that individual isn't going to be the CEO going forward because they're not commercially minded enough, and you need someone different in there. And that's a journey I think that all founders go on, whatever stage of business you're at, whether you're in pre-seed, seed, Series A. There's often conversations around are you the right person to take that company to the next stage. So it's team, it's can they deliver the opportunity, and then it's about raising your profile and ensuring that when you do go for investment, people know who you are. They recognise who you are. They recognise you're a team, and they recognise there's a big opportunity.
Thanks, Ben. What can you add, Rob?
So I think, to be honest, this is almost the critical skill set at this stage is understanding that I, as an investor, as an angel investor or any investor, is looking at the founder and say, I'm buying into you. And one of the key skill sets is, as Ben mentioned, is commercialization. Do they have business savvy? Do they understand business? And to be honest, an awful lot of founders don't. They have an idea or a product or a service, but they're not savvy business people yet. And that's what we tried to do with Innovate UK, is to develop those individuals, the personal development side of it. But you have to understand, as a founder, I as an investor, or Ben as an investor, are really investing in you first and foremost, and the business idea secondarily. So it is absolutely critical that that founder or that person that is touching the investor base or out there talking to people has the ability, and what I would call the top skill set for 2024, if you're a founder, is become a storyteller. Become someone who has the ability to convey the complexity of what your product or service solves the problem to, solves it and conveys it in a simple way. So taking complex and making it simple and understandable in that storytelling narrative, if you will. And I honestly believe that that is going to be a key attribute going forward. It always has been very key. As Ben said, having the right person in that founder CEO role is critical. And they may have a commercialization acumen and a business savvy, and maybe they've done it before or for someone else. But if they can't tell a story, if they can't educate the investor base as to here's the opportunity, here's the problem, and here's our solution to it, and here's where we can take it, and oh, by the way, here's the team we've got on board to do it, and oh, by the way, here's the advisors that we've got on board, whether it be, and I break advisors down into three camps. There's the industry experienced advisor. So if you're in FMCG and you worked for Nestle or Unilever, you've got some background there. And then the other two are, you need some legal acumen. You know how to put together a term sheet and understand heads of terms and information memorandum. But equally, you need those financial skills. So you need industry experience, legal experience, and financial experience as advisors. And I always look at a business or a founder and see who's on the team, not just the founder as that individual, but what people have they surrounded them with? Do they have people who've got experience in, if you're a prop tech company, do they have someone who's worked for a property management firm or in the industry, has worked for maybe one of the bigger players? Do they have someone who understands what a balance sheet and a cash flow and a P&L is, that understands, maybe they've talked to investors before? They've got some understanding of the key attributes of the business, because I, as an investor, will not give you thousands of dollars unless I understand that not only that you have the competency to take the opportunity forward, but you've got people around you to advise you as board advisors, as non-execs, as advisory board members, and people who've done it, been there, seen it, and got the T-shirt kind of thing. I'm just not going to give you tens of thousands of dollars to run away and, buy a whole lot of nice office furniture and put 10 grand a month into a marketing ploy. That's not going to happen. So you need to understand, as a founder, you need to surround yourself with good advisors that have been there and done it. But equally, you really need to have a strong skill set around the marketing of it and your idea and your concept. And you can tell a story, a good story, and take really complex ideas and make them simple so that everyone can understand them in the room and that everyone wants to come and talk to you.
Well, that's great. I think what I'd like to add, I think it's vitally important to understand where your marketing capability is as an organization right now and where you need to get it to what the investor expects it to be. And many business leaders see the role of marketing through a tactical lens rather than a strategic lens. And this is where you can quickly waste lots of time, effort, energy, and budget on focusing on the wrong elements of marketing. And when you look through a strategic marketing lens, you need to evaluate really and benchmark your internal and external drivers of competitive advantage. This isn't about how pretty your brand looks, how many events you do, how many campaigns you run. This is really all about building what I call brand power and increasing enterprise value. Investors will want to see how your marketing capability helps you achieve things like gain a leadership position in the market you operate, reduce the impact of new entrants, attract and retain highly motivated talent to make your business successful. It's about gaining influential and powerful influencers who can amplify your story, the story Rob was just mentioning there, to a wider audience. And it's also about getting suppliers to cut their costs and giving you more favourable terms than your competitors. And really, when you pull the right marketing levers, that's when you start adding value. You can add value by deploying premium pricing, reducing your production costs, increasing workflows and agility, lowering your sales and marketing costs, getting loyal customers to buy more from you, entering new markets, and also finding new uses for your brand. Can you extend your brand into other areas? And those really are the sorts of things investors are looking for when scrutinizing your marketing capability. I guess the exam question you need to answer is, how does our marketing capability increase value and build competitive advantage? And that's really where something like a marketing audit is a very valuable tool to sort of help you understand where you are now and what you need to transform for that investor and attract their interest and their funding. So that's probably a good point to go into the next topic. If we turn our focus to how CEOs and owner managers engage with investors, Ben and Rob, what practical advice can you give on how to initiate and maintain a fruitful relationship with an investor?
Rob, do you want to take that one?
Well, I think the important thing is you have to understand the timeline, and it does take time to build awareness in the investor landscape. So you can't, drop a deck today and expect to be raising funds in, 30, 60, 90 days. You have to understand that there is a timeline, there is a cadence to it as well, and you need to get out there. I've met a number of founders through Innovate and other channels that basically they're not known. I spoke with a young female entrepreneur last week, I think it was. She had less than 500 LinkedIn connections and she really didn't know anyone. And so that's a really, really tough market to sell into when nobody knows you, let alone knows your product or your service or your idea or the problem you're looking to solve. So the first thing I tend to talk to is awareness in the marketplace, the investor marketplace. So you need to be known. You need to have, several thousands of connections on LinkedIn, and you need to be very careful about curating those network connections. They need to be people that can connect you with people who may have opportunities to source funding or other services or support for you. So there's no point connecting, if you're a founder in the UK, there's no point really connecting with a whole bunch of people in Asia and Australia and the Middle East, if you will, unless they have what you need. So you need to raise your profile. You absolutely need to raise your profile. You need to be going in person, pressing the flesh to events that that Ben and I would go to, whether that networking in Bristol or Exeter or London or Oxford. You need to be out there seeing people, but above all, you need to become known, and you need to become known for something, whatever it is, and get your brand out there, and probably the preeminent way to do that right now is on LinkedIn. So posting on LinkedIn about the problem and seeding and nurturing the investment landscape, but then also connecting with people that are in your industry group. For example, I've got a group in Bristol right now that I'm working with that are in a specific niche in semiconductors, and we're already connecting them to a number of smaller semiconductor organizations in the US that have a venture capital arm, so that we can look to try to see if we can sell the concept and the idea into some of the venture arms of some of the larger semiconductor businesses. So you need to be, to coin a phrase, you need to be building bridges. And you need to be building bridges now if you want to be raising funding from third-party sources in the second half of next year. Because it really does take, I would say, 6 months to get a good deck together, a good group of advisors together, and for your brand, your own personal brand, and your company brand to be out there, because otherwise it's an incredibly difficult market right now. It's probably not going to get any easier until probably, I would say, April or so next year. And the tell for me is really going to be the US markets, is if the IPO markets open in the US in February, March, April next year, there will be a number of exits for venture capital. And that money, that capital will then be recycled into new portfolio acquisitions and bringing new businesses into those venture capital groups, which then filters down the line. So probably by early summer here, we should have, I would suggest, an unfreezing of the market if we see that IPO window open in the US early next year, which I suspect it will.
Thanks, Rob. Ben, do you have anything to add to that?
Yeah, sure. I think that's all great advice. I think probably my perspective on the market may be a little bit longer term, in so much as that I think there's a lot of uncertainty next year. The three of us were having a chat before the game live and speaking to someone the other day, and they were saying there's like over 50% of the democratic world have major elections next year. I think that will breed uncertainty, and obviously including the US, UK, India, and other obviously major democratic countries have all got elections, and that creates a lot of uncertainty. And the worst thing for investment is uncertainty in the primary equity markets all the way down to private equity. It all feeds through and makes things very difficult. And so whenever there's uncertainty in political, economic environment, people pull their horns in. Ultimately, they ride it out. Once they have some certainty, even if that certainty is negative, if they have some visibility of what that is, they can understand it and they can factor it in and they can make decisions or informed decisions. But at the moment, with the level of uncertainty both in the economy and political landscape, people will find it very difficult to make informed decisions about what's the world going to look like in 12 to 18 months' time, and that's people's kind of time frames. And so I think it's going to be difficult for a while. I think Rob's right. I think the releasing of equity or funds from the major markets in IPOs, etc., all filters through, all drips down, and will release money. So I'm hopeful that Rob's right, that by next summer we'll start to see some money being released into the market. But I think it's going to still be quite choppy waters for 2024, unfortunately. But what Rob was saying is absolutely right. There's hygiene things that you can do. Obviously, having a compelling deck and a compelling story, as Rob was saying, as we said in the earlier question, is about being a storyteller. Ensuring that you get around the incubators as well. So there are lots of different incubators. I'm not a big fan of people who hop between them and generally move to different incubators as their sort of current cohort or tenancy ends, but they are also very good sources of contacts for investment, because angels know that things like Set Squared and Future Space and all the other different incubators around the country, that's where the startups are and that's where the scale-ups are, particularly around the universities, etc. If you're looking for spin-outs and sort of high-tech or deep-tech businesses, they're well connected into the investment landscape, and so all the fund managers, etc., will know that they're there as well. It's still not great from a connectivity point of view, and so some of the work I do around the sort of Southwest with Tech Southwest is trying to highlight and try and bring together the sort of connectivity between the investment landscape and stimulate angel investment, etc. But it's difficult. It's still hard at the moment. So have a compelling story, have a compelling deck, and we've talked about all the things before. It's team, the opportunity. Can I deliver on it? And be prepared that it's going to be a long process and that you have to get around. You have to do a lot of buffet food, and you have to drink a lot of bottles of Beck's, and you have to do lots of events and lots of things to raise your profile around the ecosystem.
Great, some great tips there, guys. Just before we go into the next topic, just to suggest to the guests, if you've got any questions, anything that you've heard so far, and you've got a burning question, do feel free to pop it into the Q&A section on your screen, and we'll go through those after the next topic. So that kind of brings us nicely, really, to our final topic, where we discuss the pre-investment journey and what you can expect it to look and feel like. Ben and Rob, can you take us on a high-level walkthrough of what the pre-investment process looks like from the perspective of a business owner? So we've obviously got some business owners today, and they're in the process, maybe at different stages. But what does that process look and feel like from the business owner's point of view? What tips can you give them to navigate it securely?
Yeah, I think we've covered a few aspects of this, but bringing it together is first of all, someone I used to work with used to use the analogy that, you're going to have to kiss a lot of frogs. Okay, so you're going to have to spend a lot of time with investors, both angel investors and also with fund managers, trying to convince them to part with some investment into your business. And so, it's a bit like speed dating. It's a little bit like blind date. It's, those sorts of aspects where you're trying to sell yourself and your business to some, to some wealthy individuals or to fund managers with access to capital. You've got to stand out amongst the crowd which are out there, because, as I said earlier, I think in Angel Investors Bristol, for example, just to give you an idea, in November we had 50 requests. People come to us looking for investment, and it's predominantly Bristol, South West, and a bit of South Wales. We had 50 companies in November alone come to us, and so it's not unusual for us to see a lot of decks. And so you need to stand out, because it's a bit like hiring. When you get a lot of CVs, you're looking almost for reasons to reject people. And so there's almost you need to be really quite compelling and quite impactful in a short space of time. If you get an opportunity for an elevator pitch, make sure you've got that 30 seconds, 1 minute patter that you can get across what your business is. But I think there's a few hygiene things as well that you can do to make things and make the process through more quickly or more smoothly. And things like SEIS and EIS advance assurance. So SEIS and EIS are tax schemes provided by the government that incentivize individuals like myself to invest in high risk companies. Obviously, investing in small unlisted private companies is quite high risk. The risk of failure is very high, and therefore the government incentivize those types of investments through a couple of schemes. And you can get your company what's called advance assurance. So the HMRC will say, yeah, your company qualifies for SEIS, EIS. So it's quite important to have that. So generally, as an angel investor, I won't look at your company unless you have that advance assurance in place. Make sure you've got what's called a data room. So you've got all your documentation around the formation of the company, the governance, the directors, any IP, so patents or trademarks, etc. All that documentation, all in what's called a data room, or at least accessible and easily organized and easily accessible by an investor who's looking to get more detail or undertake due diligence on your business. So take a deep look at your business if they're looking to invest. So it makes it easy for them. So anything you can oil the wheels, remove any friction, so if they ask for something, you can give it to them rather than having to go away, put it together. It's all time consuming. And so if you can be pre-prepared for those types of questions, there's lots of articles and lots of stuff around due diligence and what sort of documentation you need to have. It's obviously dependent on the type of company you are, but if you can get that documentation in place before you start the investment process, it can speed things up quite quickly, and it makes you look prepared and it makes you look professional.
So I think for me as an investor, I'm not here to make friends. I'm here to make money. So I think if you as a founder or a business owner understand the way we come at it is, I don't just want to double my money. If I give you 25 grand, I don't want 50 out. I want a multiple of that, because I will have an awful lot of businesses, and probably 4 out of 5 of the businesses that I invested will go nowhere. So there has to be an opportunity to make significant upside potential with your organization, with your business idea. So in order to do that, like as Ben said, you've got to kiss a lot of folks. You've got to talk to a lot of people. But we're very fortunate that the two of us are based in the UK. We probably do have the preeminent business support structure for founders and startups globally. The difficulty we have in the UK is we have a mindset around risk that is relatively risk averse. Whereas I lived for 20 plus years in the US, where there is a very, very low threshold to be willing to put money into an opportunity. So there is just more liquidity and there's less risk associated with it. But one of the things that I look at as an investor is, not only do I need to believe in you as the founder and your business opportunity, I really want to see where you as a founder have come from. What have you done before? Have you been in a startup? Have you been in an accelerator program? Have you had a few failures perhaps in life? Like you tried to get a product off the ground, couldn't get a market fit and gave up on it, kind of thing. So I really want to see some sort of resilience and persistence from you as a founder, because I'm not going to give you tens of thousands of dollars to go and put it into a marketing scheme and some nice office furniture. I want a return on my money. And And I think as founders, you have to understand that is the mindset. I'm not here to make friends. I want a business opportunity that I can make money on. So I will give you capital to create your vision and to drive towards what the opportunity is, but you've got to give me something at the same time. And the other thing that I would accentuate to any founders is please don't come to me on your own. I'm not going to invest on you just as a solopreneur with a great idea. I'm not going to give you tens of thousands of dollars. You need to have either a team around you of virtual or a fractional CFO or a fractional CMO, but you need advisors too. You need people that have said to you, that's a daft idea, don't do that. Have you thought about this idea? So, the number of decks that just get thrown out that don't even get more than 20 seconds of a viewing are those people that come at people like Ben and I with no one on the team, no advisors, no background, and just what they think is a good idea. That's not gonna raise any money at all, to be honest. Not in this environment, anyway. So you have to have a founder or someone who's fronting the opportunity that is believable, that is the old like, know, trust. I need to trust you. I had an instance back in the US back in 98, where I gave some money to someone and I never saw them again. Quite ridiculous because that was my due diligence. I'm never going to do that again. So I have to know you. I have to like you. And over a period of time, and that's why you need time, I need to trust you. I need to trust you that you're going to do the right thing for the business at the right time. You're going to bring on board the right people and you're going to go after the right markets and the right customers or client base. And it really does take time. You cannot do this in 30, 60, 90 days and get the sort of investor on board that you want. You really need to be starting day one today. You need to be building that deck and building that knowledge and building that awareness in the marketplace, and maybe talk to people February, March, April, May next year, and then look to put something in play maybe the third quarter next year after the summer break, but be ready to hit the ground and really work it hard. But the other thing I would advise is you need advisors on your board. You need advisors around you, whether they're industry specific, legal or financial. You need advisors. And to be honest, I won't touch a business unless you've got some advisors that I can look at, talk to, do background due diligence on, because believe me, I'm going to do plenty of due diligence on you, your business, your marketplace and your advisors before I give you a cent of my money.
Rob, it's a good point around advisors. Is the number of times I see decks and they have a plethora of advisors. But my first question always to the founder is, when was the last time you spoke to them? Because I'm going to check. Because the number of times you see that, they'll put an advisor on there and it's some specialist in their area or some, but they probably spoke to them 6 months ago and asked if they could. Right. So absolutely, you're spot on, Rob. You need those advisors around you, but make sure they're real and they're actually they're on board and you are engaging with them, because I will check. So don't put them on for vanity. Make sure they're real, because I have come across that.
It's a great point. I mean, I've had people come at me just to be put on their pitch deck. It's like, well, no, you're not going to rent my name, then report me as an advisor to you, because that's just not going to happen. But it does happen, And the other thing I was going to add to that as well is the Innovate UK is the major funding arm for founders in the UK. And if you get an award, whether it's a Fast Start grant, a Smart grant, or whatever it is, that is accreditation, and that is very valuable to investors. If I can see that you've been through the filtering mechanism to be awarded a Smart grant, that's a real badge of honor to me. And as an investor, I'm like, okay, that's a good tick mark. Would you agree, Ben?
Absolutely. When you think, the Smart grants from Innovate, they're for those who don't know, they're kind of on a quarterly basis. The Innovate have pots of money for different sectors, industries, areas or themes which the government, I suppose, are looking to promote, like healthy aging and those sorts of things. But there's also then this kind of coverall grant option, which is called the Smart grant, which is basically to mop up any kind of other type of innovation that perhaps doesn't necessarily fall into one of the other categories. And the success rate for Smart grants is, I believe, somewhere in the 5 to 8% of applications for a smart grant will
I
succeed.
I think that's on the high side. You're right. It's very, very low. So if you've got that accreditation, if you've won an award, it's potentially huge.
Yeah.
It
Absolutely.
really is very, very.
Yeah, the due diligence process that you go through for an Innovate grant is, and also the governance and the process that you need to follow is quite rigorous. And so, yeah, as an investor, if you've got a grant from Innovate and a substantial grant, then that is seen as not only is that's great because that's undiluted funding and it kind of almost multiplies my investment in a way because I'm kind of unlocking that grant, but it's also a big comfort to me that you've been through that process and that therefore people have reviewed that and they bring like experts in for each of the applications to check, to run their eye over them. And so they've gone through a sort of due diligence process already on your business and on your idea. That provides me with a level of comfort because just knowing how difficult it is to get one.
Yeah, we had the most recent one was the UP program with a begin and build filtering mechanism. I had 10 founders that went through and put applications in. Only one got the follow-on 50,000 funding there. So the filtering mechanism is very real, but it's very tangible and it's very valuable. And so that was a real eye opener. And to be honest, I think they had something like 2,200 applications for that. So that's hugely competitive. It's far easier to get into Harvard or Yale than it is to get an Innovate UK grant.
Fantastic. Guys, I'm just conscious of time now, so it's probably time to ask the audience if they've got any questions. We've had a great question in from Molly, actually. Actually, Molly's got two questions, so we'll probably split it up into two. Molly's asked, what kind of multiplier or return criteria would you be looking for and what sort of IRR? And does that vary between the UK and US mindset? So great question there. Thanks for that, Molly. Who'd like to pick that one up?
Shall I go first and then you can pick up the US aspect of it, Rob? Is that a good idea? So as an angel investor, it's interesting actually. And we have this discussion, and again, so from my experience of running an angel group and trying to find the types of investments that our members want to see, it's not only split between types of sectors or things that they're interested in, but it's also about duration and return. So we try to put to our members companies that different durations of exit or potential exit, I suppose. So when you're investing in early stage businesses, particularly if they're deep tech businesses or may need to go through a regulatory process or anything like that, the time to return can be plus years. I've put my money in now. I'm not expecting to see anything out of that for a good, a decade of return. So on that basis, I'm wanting the upside to be quite significant, bearing in mind the number of hurdles and the risk, etc., at that early stage for it to go for over that period. Now, we also present companies which perhaps are already revenue generating or close to revenue or less low or more low tech, but also have a potential exit in maybe the next 3 to 5 years. And therefore, my expected return on those may be lower, but I know if there's a better chance of that succeeding, I can recycle that money or that investment. Hopefully, it's a positive return, and I can recycle that back into the market. So, as an example, I'm probably looking for returns for anything that's sort of 10 years. It's got to be 10, 20 times my money, preferably a lot more. But that's the sort of return I'm at least looking for that sort of period. For a shorter one, it may be 3 to 5 times in reality, if it's going to be a shorter duration, I suppose, of investment. But one interesting point, and Rob touched on it, around investment funds. So the way that VCs look at this is that if they invest in 20 companies, it doesn't matter if they have 4 or 6 successful investments out of those 20. If they only return 10 times, they see that as a missed opportunity. They're looking for one of those 20 to be a unicorn. So that's a $1 billion business. They need one of those investments to become a unicorn. Otherwise, they don't get the returns they need for their investors in those businesses. So you've got to remember they're all, the funds, particularly as you go down the seed to Series A and those sorts of situations, they are really shooting for the stars. And so they are looking for companies. They're not looking for companies and go, we're gonna 10x our revenue over the next 5-6 years. They're not interested, and they want you. If you're not going to be 100xing your revenue over the next sort of 3, 4, 5 years, if you're not on a gross margin of 50 to 80%, those are the companies that are going to generate the unicorn status they need out of that one in those 20 companies to go. So they'll aim for 20 of those and hope one comes off. And so that's their kind of view.
So the US is not really any different. It's just bigger numbers. My numbers are 7, 20, and 100. I never look at an investment in less than 7 years. If there's an exit in 3 to 5, great. But it has to be a significant multiple of what I went in at. I'm looking for 100 times investment gain. If I'm putting £1,000 into your business, I'm looking for 100x that on exit. I'm looking for generally minimum 30% growth year in, year out, annual revenue, recurring revenue growth. One of the key things for me is I'm always looking at the exit multiple. And exit multiples in the UK are lower than they are in the US. For example, I had an exit in the US that was a 10x sales multiple exit. And I tend to work on a sales exit multiple rather than an EBITDA multiple. The exit multiples in the UK are lower. The expectation is lower. The opportunity is smaller. In the US, it is much, much bigger. So the expectation is that there will be an exit multiple of 8, 10, 12 times sales. That would be acceptable. But back to Ben's point about the multiple has to be significant because it has to cover the losses to any investor, whether you're running a VC group, a private equity firm, a family firm, or a solopreneur venture builder, as I do. It has to be a significant return. So I will hold on for 8 years if necessary, but equally, I will also try and get my equity out early. So if I can see an opportunity, if I put 25 grand into a business, if I can see an opportunity to bring in new investors and to exit my initial principal capital investment, but retain a stake in the business. So if I can take out my 25K that I put in, but retain a minority stake, maybe a 1 to 5% stake for the equity I've built up, or maintain an advisory concept with that business, that's worthwhile to me. So I'm looking to preserve my capital, but significant multiple.
Fantastic, great answer, guys. And I think you answered Molly's other part of the question, which was over what horizon period would you be looking for? And I think you both covered that. I guess it depends on the company and the size of the investment in the first place. Molly, do let us know if you've got, if you didn't answer it properly there, but I think we've covered it off. We've got a great question here from Abraham. For some companies, defensibility is more challenging. For example, software companies. What would make such companies more attractive? Traction, revenue, ? Over to you.
For me, it's revenue. You've got to have customers. An Innovate UK grant is great and all, but it's not real revenue. So for me, you've got to have revenue. You've got to have customers. And if you've got contracts for recurring revenue, more's the better. But if you've got, whether it's £1,000 or £10,000 of revenue booked, that is much more attractive. So I would always focus on get client, get customers, because investors will love you for it.
Fantastic. A great question here from Alex. How do you find investors investing in specific market areas, like investing in drones or AI? Great question, Alex.
It is a great question. And it's the perpetual issue. But I have come across a great new platform called Chipshape.com. If you sign up to that website, it's free to sign up. Basically, what it will do is searches, say you want to invest in drones, or you are a founder in the drone market or the AI market, and you want to find investors who are investing in that. You can search on keywords, and it will bring out, it's got, a database of tens of thousands of investors across the world, and it will find companies, similar companies they've invested in, that feature on those keywords, etc. So if you're looking for investors for drones, for example, you tap in drones or investors in drones, and it will search through the news feeds, the LinkedIn profiles, all the different things around those types of investors that it's got within its database, and pull out relevant content for you, and that you can go through and see what other companies they've invested in, they've commented about it, or they've talked, or it's been in the news or anything like that. And so it's really quite a useful tool. Well, there's other things like Bowhurst, etc. as well. So, tools such as those where you can go to their website and you can search for investors into drone companies, and they'll look at funds and it's also angel groups and those sorts of things that invest in those types of areas. So there are tools out there for you to be able to find those types of investors.
Any other tools you're aware of, Rob, on top of what Ben just mentioned?
I would again use use LinkedIn and understand, and again, use the search profile is look at people who are in that industry, who even mention on LinkedIn. Now you can mention 5 things, you can hashtag them. You need to hone in, you need to find an investor that understands your offering. There's no point going to a pharmaceutical company and trying to sell them a drone idea. You've got to be honed in on that industry segment and find out who has an appetite for that. So as Ben mentioned, that website is a really good source for finding people who have the appetite for what you're offering.
Fantastic. I'm just conscious of time now. We're drawing to a close, so we don't have any further Q&A. So what I'd like to say, thank you very much for everyone who's joined us and stuck to the end. We really appreciate your time listening to our investors, and I really hope that you've found today's discussion useful, and I hope it better prepares you for your investment journeys ahead. I'd like to say a very special thank you to both Ben and Rob for sharing their time, because I know they've got very, very busy schedules. So thank you so much, guys, for sharing your secrets today. It's been really appreciated. Thank you again, and we very much look forward to seeing you again soon.